This week, SpaceX faces its first real public test. Earnings drop Tuesday after the close, and 2 days later, a massive lockup expires, unlocking over 900 million pre-IPO shares. The stock has already given back more than half its post-IPO gains, and now sits near $108, well below the $135 IPO price. Bulls see Starlink, Starship, and the AI business as the path to a multi-trillion-dollar future. Bears see valuation risk, dilution, and a company still deep in the red. This is the collision that decides the next leg. SpaceX reports its first quarter as a public company on August 4th after the market closes. This is the market's first clean look at the numbers. Wall Street is looking for roughly $6.8 to $6.9 billion in revenue. That would be a sharp step up from the $4.7 billion posted in the first quarter. Adjusted earnings per share are expected to show a loss around 23 cents. EBITDA is projected near $2 billion. The real focus will be the breakdown. How many new Starlink subscribers joined, and what revenue growth did the connectivity segment deliver? How many Starship test flights or production milestones were hit? And how is the AI segment performing after the February acquisition of xAI? Management has never given formal public guidance before, so any forward commentary on full-year revenue, capital spending, or path to profitability will move the stock. This report is not just another quarterly update. Until now, investors have been pricing a story. Starting Tuesday, they get actual reported revenue, actual segment margins, and actual cash burn. That data will either support the multi-year growth narrative or force a re-rating of the still massive valuation. 2 days after earnings on August 6th, the first major lockup expires. Roughly 911.5 million pre-IPO shares become eligible for sale. At current prices, that is nearly $100 billion of potential supply hitting the market. Public float is still thin, so even partial selling can pressure the stock. Short interest has been climbing into this window, adding another layer of uncertainty. The other major variable is the AI business. SpaceX completed the acquisition of xAI in February. Musk has publicly suggested the AI and Grok-related operations could eventually contribute Tesla-scale revenue within 12 to 24 months. Investors will listen closely for any color on AI revenue, compute contracts, capital intensity, and timeline to meaningful contribution. There is also ongoing chatter about a possible Tesla-SpaceX combination. That remains pure speculation. Musk has called certain related reports fake news and has said any combination would have to follow the proper process. Treat it as a background wildcard, not a base case assumption. Morgan Stanley keeps an overweight rating and a $300 price target. Their thesis rests on 3 pillars. First, Starlink's growing dominance in global broadband and the path to higher margin, enterprise, and direct-to-cell services. Second, the AI optionality created by folding xAI into the company and the potential for orbital and terrestrial compute. Third, the long-term infrastructure moat, reusable launch leadership, Starship scaling, and the ability to own both the rockets and the satellites that use them. If Starlink's subscriber growth stays strong, AI contracts ramp, and Starship flight rate improves, the current valuation can look like a starting point rather than a ceiling. Bulls argue the market is still underappreciating the combined power of launch, connectivity, and AI under one roof. The consensus 12-month target sits around $236, well above today's price, reflecting that longer-term optimism. The bear case starts with valuation. Even after the sell-off, SpaceX still carries a market capitalization north of $1.4 trillion, while continuing to post large net losses. The lockup release adds real dilution risk, just as the first public numbers arrive. Execution risk remains high on both Starship cadence and the successful integration and monetization of the AI business. Some analysts see the stock as priced for perfection. One firm, Phillips Securities, initiated coverage with a sell rating and a $75 target. Short interest has risen meaningfully into earnings. If revenue growth slows, AI contribution disappoints, or capital spending stays elevated longer than expected, the multiple compression could continue. The range of 12-month targets stretches as low as $62, showing how wide the disagreement remains. Here's how I'm personally positioned. Last week, I was short a 75 put that I sold on July 30th. It expires March 19th, 27. I collected $8.31 in credit, and my break-even is $66.70. If the stock keeps sliding, my plan is level-based. If SPCX drops below 100, I will sell another cash-secured put at the 65 strike. If it falls further to the next support level, I will sell another put at the 60 strike. This is a laddered approach, reacting to price action one level at a time rather than trying to call a bottom all at once. Classic wheel-style scaling. This is simply how I'm managing my own risk and premium collection. It is not a recommendation for anyone else. That's the setup heading into SpaceX's first public earnings and the lockup-unlock. Subscribe for the post-earnings breakdown. This is not financial advice. It is for informational and entertainment purposes only. Always consult a licensed financial advisor before trading options or any securities. See you in the next one.